Hello investors, welcome to Simpli Stocks. Q4 or the March quarter earnings season has started on a very positive note. Despite so much uncertainty at the macro level, many good businesses have delivered good results. So in every earnings season, my goal is to cover as many well-performing businesses as possible for our YouTube audience. In the same direction, today in the first video of our Q4 FY26 results series, I will cover 4 small cap businesses from 4 different sectors that have delivered good results. Also, their management commentary for the future is also quite positive. So without wasting any time, let's get started. The first business we will cover is Tips Music. Tips operates in the music licensing business. On one side, they produce songs or sometimes even acquire them. Then they license these songs for use in movies or upload them on platforms like YouTube and Spotify. Apart from that, other things like dance shows on TV, concerts, etc. also contribute to the revenue as performance rights. As of today, Tips owns more than 34,000 songs. As you can see here, songs like Atif Aslam's Jeene Laga Hoon, Arijit Singh's Tera Fitoor, or songs from the movie Raaz are in Tips portfolio. This is Tips YouTube channel, and as you can see here, they have more than 81 million or 8 crore subscribers. And this is the moat in this sector, that once you have built a content library or a strong channel presence, you earn from it for years and years. Plus, Tips has a very good portfolio of 90 songs. Now, let us quickly look at their results, and then I'll tell you the interesting triggers which are playing out in this business. In Q4, their revenue grew by solid 32% and profit increased by 93%. If we look at full year, sales growth was 21% and profit growth was 30%. Tips has surprised the whole market in Q4 because their Q2 performance was not that good and management commentary had also become a bit dull at that time. But this 32% top line growth has lifted the performance for the entire year. The PAT growth will seem high to you because less content cost got booked this quarter. David Dhawan's upcoming movie है जवानी तो इश्क होना है, that movie got shifted from Q4 to Q1. So they couldn't book that album cost in Q4, which will now be booked in Q1. For FY27, that is this year, management said that they will be spending 80 to 90 crore rupees to acquire new businesses. Now, as you can see, it is a high margin business. Their profit margins have been above 50% for the last 2 years. I'm talking about net profit margin. And you might say that P ratio is at premium, like right now, this business trades at a multiple of 40. But understand the moat of the business, because songs can generate ad and subscription revenue for years. That is why you will see an ROE of over 80% here. Coming to the future outlook, their management has committed to 20% revenue and 20% PAT growth. But there are 3 interesting levers because of which I believe this business can do better than that. Let us understand them one by one now. The first and major trigger for Tips is that their revenue model in YouTube Shorts is going to change. Until now, the company used to work on a fixed price model, but they negotiated with YouTube, and now, like long format videos, they will now move to percentage share of ad revenue. This should happen by this April end or the beginning of May, and it will be a big trigger. The consumption of shorts is very high. They will benefit from the model change, and when their songs go viral in the future, they will get non-linear benefit. As in, whatever revenue comes in will pass straight to the bottom line because the cost has already been booked in the past. And YouTube is a big platform for Tips. About 40 to 50% of their revenue currently comes from here. Then there are 2 more triggers that will help in the medium term: paid subscriptions and public performance rights. Paid subscriptions include platforms like Spotify and JioSaavn. Public performance includes concerts and live shows. Currently, both these segments contribute to 20 to 25% of revenue for Tips, and both industry segments are growing at 40 to 50% CAGR. People now prefer premium subscriptions for better experience. Like, you yourself would probably get irritated listening to ads, right? Or you might hit the daily limit that is there. Also, concerts are also rapidly growing in India. So that is a lot. So there is a lot of scope over here. So looking at all this, we can say that in the near future, there can be a year when all these levers play out together and revenue growth rate can increase from that 20%, which is there right now, to 30-40%. Whenever the growth rate accelerates, the market gets attracted to that business. The YouTube deal is a near-term trigger, while subscriptions and public performance are medium-term triggers. The next business we will study is SBFC Finance. SBFC is an MSME-focused NBFC, and it gives loans of 5 to 30 lakh rupees to small businesses. This segment itself is growing at a 24 to 25% rate. Let us look at their results, and then I'll talk about the macro environment which is affecting or can affect this business, because understanding that is very important, because supply chains have been disrupted due to the war. Big companies are focusing on keeping their costs low, and in such an environment, your MSME suppliers or vendors, they get squeezed. Performance wise, Q4 has been good across all metrics. AUM, or the amount of loans the company has given out, has grown 29% since last year. Secured MSME disbursements or new loans grew 12% quarter on quarter. It is not written here, but on a full year basis, 16% growth has come. SBFC gives loans against both property and gold, and like other lenders, they have also benefited from growth in gold lending. The share of gold loans has increased to 20 to 21%. Secured MSME has a 79 to 80% contribution right now. Their target last year was to open 25 new branches, but they have beaten that by opening 46. This branch addition will now help to bring in growth in this year, or FY27. Asset quality numbers are largely stable. If we go deeper, you will see that although interest income and borrowing costs have both decreased because the RBI cut the repo rate, at the net level, the yield and cost of funds have improved. Therefore, the spread or margin has increased. Furthermore, their operating expenses ratio has also improved. Credit costs have increased, but that is not a concern. Since there is so much uncertainty at the macro level, they are being cautious, and they have also increased their provisioning for stage 2. However, management also said that while their full focus will be on ensuring NPAs don't increase and credit costs stay stable, but from here, investors should not expect a reduction in credit costs until the situation improves, which is fair. There is definitely more scope in OPEX to AUM, but not in credit costs. And overall, you will see that ROE has increased from 13% to 14.5% on an annualized basis. From here to, management has a roadmap to grow leverage and ROA to increase ROE over the next 2 years without raising capital. The stress that had started building in the DPD plus 1 bucket in the previous quarters has come under control. In this environment, although the results are good, management is cautious about the near future. But then again, you will see that management of almost every company is keeping a cautious tone right now. Their growth guidance is still intact. They have spoken about growing AUM at 5 to 7% CAGR quarter on quarter, which works out to the same previous old 20 to 30% growth guidance. Aside from that, there will be a marginal benefit from operating leverage. My advice would be that if you don't hold SBFC or any other good MSME lender, you can explore this business slowly, but right now you should not take a big or bulk allocation in the MSME space, because if the war drags on and the supply chains stay like this, problems will increase for small businesses. But don't ignore SBFC entirely either, because it is currently trading at an attractive valuation due to the uncertainty. And as soon as the war is over and business activity gets back on track, the sector will pick up speed again. Now, a humble request, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are my only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Coming back to our discussion, the third business on our list that had good results is DCB Bank. DCB is a small cap bank. Its market cap right now is just 6,000 crore rupees. It is growing at a healthy pace from this small base. Their major presence is in Gujarat, Maharashtra, Odisha, and Telangana. Their advances grew 6% quarter on quarter and 17.6% year on year in the March quarter. This is the money that DCB has given out as loans. Within this, their mortgage loans, which holds the largest share in the loan book, saw 10.7% growth. The co-lending portfolio grew by 25%. In co-lending, you give loans together with other banks or NBFCs. Similarly, gold loans corporate, MFI and farm equipment segments also contributed to growth. Actually, co-lending is anyways mostly gold loans for DCB. From here, they will grow co-lending at the same rate as the overall bank growth rate, because even though there is growth and costs are low, the yield is also low, meaning it is not that high margin segment. Their deposits or the money you or I deposit in the bank also increased 21% compared to the last year. These are the two parts of any bank. The bank takes deposits from people on one side and gives loans on the other side. The margin in between is the bank's income. DCB intentionally keeps deposit growth higher than advances growth so that they have enough liquidity. Now, let us look at asset quality figures and fundamentals. Slippages and gross and net NPAs have all improved year on year and quarter on quarter. That is why you will see the credit cost here has improved from 0.37% to 0.32%. So overall, DCB is growing in a good direction. There was a management change here. Since the new CEO, Praveen Kuttiji, took over, he has improved the bank across several parameters. And now finally, their net interest margins have also started increasing, because this is a trigger. When rate cuts happen, the benefit is passed on to the customer immediately, but it takes NBFCs or banks 1 to 2 quarters to adjust their costs. But that is, you will see, finally happening now. Lastly, looking at the P&L statement, interest income grew by 17%, but treasury income was weak this quarter. Treasury income comes from trading of government bonds, forex and derivatives. Because treasury income was low, other income came in lower, but that was expected. A positive thing you will see that here other fee income that grew by 22%. This includes revenue like when the bank sells you insurance or any other product at their branch. They have a target of becoming a mid-sized bank and doubling their balance sheet every 3 to 4 years, and they are making good progress at a healthy rate over here. There is just one overhang, which is their CASA ratio. This is the only thing that is still not fixed here, but management is putting all its effort into increasing the or getting better the CASA risk. If CASA mix starts going up, DCB will become a near perfect bank, so to say. But it is not like it is bad right now, completely bad. It could be better. And to counter this weak CASA ratio, they carry excess liquidity. And as I mentioned, DCB Bank's base is small right now. The market cap is just 6,000 crore rupees. Last time when I covered it, it was trading at a PB ratio of 0.8. Now it has reached a multiple of roughly 0.95, but still you will see there is a lot of scope from here as well. But it is the same thing like SBFC, the commentary is a bit cautious. So don't rush. The war is having a direct impact on our lives. There is inflation for both corporates and households. But yes, growth is looking good. This is a good small cap banking business that you can keep on your radar. The fourth and final business is Bajaj Consumer Care. It is in the hair oil segment. If you have heard of Bajaj Almond Drops hair oil, that famous brand is theirs. Besides that, they have a portfolio of coconut and other hair oils too. I recently did a video on FII buying in which I discussed those businesses that FIIs have added in the March quarter. Bajaj Consumer was part of that. In Bajaj, you will be surprised to see that FIIs have increased their shareholding by 6.7 percentage points, going straight from 9.7% to 16.6%. During this time, DII ownership stayed roughly the same and public shareholding has decreased. The reason for this institutional interest is that Bajaj Consumer is doing quite well under the new management. The new CEO, Naveen Pandey, has taken initiatives around pricing, distribution, revenue management, and also mix improvement. As a part of mix improvement, they are focusing on slightly higher margin hair oils. The video is getting a bit long, so let us wrap this up quickly. So you will see that for the months of January to March, their sales grew by 32% over the last year. If you remove the acquisition of Banjaras, the brand they recently acquired, the top line growth is 28.5%. In ADHO, there was almost double-digit volume growth, around 8 to 9%. This might seem low to you, but this growth is after the accounting for ML reduction. They reduced the quantity in their bottles and sachets ML wise to improve margins. And that is why you will see a very good margin improvement here. Gross margin went from 54% to 63.6%, and EBITDA margin jumped from 13.3 to 23.7%. Similarly, PAT margin went from 12.6 to 19.5%. So you see how a complete turnaround has happened. And management is very confident that except for short-term shocks that will come from the rally in crude oil prices, which might lead to margin pressure in Q2 and Q4. Otherwise, management is confident that EBITDA margins will now stay in this 20 to 25% band. You will see that margins for the whole year FY26 are lower than Q4, meaning on a full year normalized basis, when everything runs normally, it can report very strong bottom line growth. Bajaj Consumer has a plan to double their non-almond drops hair oil portfolio by growing it at a 30% CAGR. And for their core categories, they are targeting around 10% growth. This is a healthy growth in the FMCG space. Currently, Bajaj trades at a PE of 30, whereas you will see FMCG businesses usually get a slight premium. If the growth sustains from here, we can see a good re-rating happening in Bajaj. Else, risk-wise, I will say only concern is inflation around raw materials. The price of liquid paraffin has gone up because of the war. Their margins are not affected yet because they have old inventory line. But if supply chains don't normalize, margin pressure will be visible in Q2 and Q3. But FMCG, I will say, is a structurally strong sector. If drawdown does happen, the valuation will become even more attractive from a long-term perspective. So you can look at this business. It is a simple model. You don't have to overthink about it. I guess you will like it. Now, see, the earnings season has just started and companies are announcing results back to back. If you are new to our channel, make sure you subscribe to Simpli Stocks. I'll be bringing many such business analysis in the future. And if you found this video helpful, make sure to hit the like button. If you support us with your likes, I'll be much more motivated to bring more such videos for you on a regular basis. So don't forget to like, and yes, don't forget to subscribe. I'll see you in the next video. Happy investing.